then you get to a point where interest rate hikes increase the deficit at a bigger rate than they slow down bank lending. That's when you do risk losing control of inflation. And it depends at that point how many offsets you have. If you're a country running, if you're super productive, if you're running a current account surplus, if you're not short on energy, it might not be that inflationary. But if you go into that environment and you're running a current account deficit and there's risks of energy shortages or risks of supply chain disruptions, and you're running 6, 7, 8% of GDP deficits structurally, and the central bank has to buy some of it, regardless of what inflation's doing. Right. So, I mean, for example, the Bank of Japan was buying bonds while they had above target inflation because they didn't really have a choice. And so when you get into that kind of loop, that can give you a higher background level of inflation than you get in other macro context.
Lyn Alden warns that the US economy may be nearing a critical tipping point, one that could force a significant government reset. The latest data shows that the Treasury's aggressive issuance of T-bills, coupled with the Fed's attempts to manage the balance sheet, is creating major imbalances in the financial system. As US debt surpasses 130% of GDP, even minor interest rate hikes are now more likely to increase deficits faster than they slow down bank lending. This dynamic could lead to a scenario where inflation spirals out of control, forcing the Fed into difficult decisions, including the possibility of forced monetization. The situation is eerily similar to what Japan has experienced, where the central bank had no choice but to buy bonds even with inflation above target. With the US running a current account deficit and facing potential energy shortages, the risks are magnified. Alden suggests that if these imbalances continue to grow, the US could be on the path to a structural reset, with significant implications for the global economy.
So right now, and there's a recent paper on this called Activist Treasury Issuance, and it's something I've actually been covering for the past year and a half, which is that the Treasury is offsetting some of the actions that the Fed is doing. So by shortening their, by increasing the ratio of T-bills relative to coupon bonds, they've been able to pull money out of reverse repos, right? So there's a lot of money market funds that are basically excess demands for like cash and cash equivalents, and it had nowhere to go. And the Fed did not want that pool of capital to drive T-bill yields below their target rate. And so they allowed the reverse repo facility, so extra money can kind of pour into that, rather than pushing T-bill yields too low and kind of impact their hawkishness. But as the Treasury issues more and more T-bills, those money market funds and other pools of capital can get out of reverse repos and get into T-bills. And so even though the Fed is still doing QT, the rate of reduction of reverse repos and putting that capital back into the banking system has been kind of a little bit higher than what the Fed is doing in terms of their tightening. In addition, when you look at the New York Fed's projections on the balance sheet, probably by late next year, they expect to stop decreasing their balance sheet and might be going back to kind of mild increases in their balance sheet to maintain what they consider adequate reserves in the financial system. So all that's to say that I think we're somewhat range bound, but on net headed up, and I think we probably have seen the low in U.S. M2. Even though I wouldn't expect fireworks anytime soon, but I do think we've likely troughed.
So a more stimulative environment could be in the works, coupled with the Fed cuts next year. Is that fair to say? I
think we could see more of a mixed environment, like a malaise. Like in this past period, like I said, we had strong consumer, strong travel, areas like that, but then weak manufacturing, weak real estate. We could see somewhat of a stabilization of both. Like there's signs that manufacturing, the rate of change might have troughed, right? So even though the PMI is still below 50, it's off of it's not really getting worse. It's off its lows, and we could see a little bit of a spark in some of these more cyclical things as the consumer side maybe doesn't run quite as hot as it did before, and that the overall U.S. economy could run softer for a period of time. And then if we do cut in response to that, that gives the global markets some breathing room, particularly developing countries that have dollar-denominated debt, where a kind of a cut in U.S. interest rates is kind of a cut for them. and kind of good for their liability side, softens up their liabilities potentially. So I think we could see a period where the US doesn't necessarily take the leadership role in global economic growth and instead lets the rest of the world grow and kind of pull us along with it for a period of time. So part of it is that as that runs higher and higher, eventually you get a problem with not enough buyers. And you could have a situation where the Fed has to go back and be a buyer, even if inflation's above target, which could happen as early as next year potentially. And you can get into kind of forced monetization, which that if you're in a structurally deflationary environment and you have enough offsets of keeping prices low, that can be palatable. That's kind of what Japan's gone through, and they have a structural current account surplus and all that. But if you enter that environment in a great power competition or from a position of running a structural current account deficit, that could translate into more inflation that the average person sees, the average voter sees, the average investor has to deal with. And so that's kind of the main thing. In addition, the other factor is that it means that interest rates don't have the same effect they had in a lower debt environment. So for example, when Paul Volcker was trying to deal with inflation, the majority of the money growth was coming from bank lending, and federal debt was 30% debt to GDP. So when he raises interest rates, he slows down the rate of bank lending, and he does blow out the fiscal deficit, but by a smaller amount than he slows down bank lending, right? So it's on average, his interest rate hikes are very cooling on the economy. Whereas if you get to 130 debt to GDP on the public ledger, and your deficits are bigger than your net bank loan creation in a given year, then by raising rates, it's more of a mixed bag because you're ironically increasing the deficit, which is somewhat stimulative for the private sector, at a faster rate than you're slowing bank lending. And it's not quite an apples to apples comparison because bank lending it's more cyclical. And the interest expense more goes to the upper echelon of income. So it doesn't have the same velocity as other types of deficit spending, but it does have a non-zero propensity to spend. And so some of those just inflation fighting dynamics become harder when you're that indebted. Private sector debt, especially when it starts to roll over, is disinflationary. That's what we saw after the global financial crisis, as we saw Japan go through. However, when you kind of rotate that debt from the private sector onto the public sector, and then you get to a point where interest rate hikes increase the deficit at a bigger rate than they slow down bank lending, that's when you do risk losing control of inflation. And it depends at that point how many offsets you have. If you're a country running, if you're super productive, if you're running a current account surplus, if you're not short on energy, it might not be that inflationary. But if you go into that environment and you're running a current account deficit and there's risks of energy shortages or risks of supply chain disruptions, and you're running 6, 7, 8% of GDP deficits structurally, and the central bank has to buy some of it, regardless of what inflation's doing. Right. So, I mean, for example, the Bank of Japan was buying bonds while they had above target inflation because they didn't really have a choice. And so when you get into that kind of loop, that can give you a higher background level of inflation than you get in other macro context. Part of it is the sheer amount of it hitting the market. Right. So, and for example, U.S. banks have historically been a big buyer, but then some of them literally went bankrupt because of it. Right. The volatility of it. They have to have certain liquidity characteristics. They have to have things like enough cash and T-bills and things like that as a percentage of their assets. And some of those long duration treasuries are a risk they have to balance around. So eventually you can kind of stuff overweight treasuries in so many different places that there's just not a lot of buyers for them. In addition, the rest of the world buys our treasuries, but they've not been buying at a very rapid pace in recent years, and they can only buy with dollars that they have. So if our they run trade surpluses with us on average, the rest of the world. and they take that and buy our assets with it, including some of our treasuries. But if our treasury issuance is just massive compared to how much dollars we're putting out into the rest of the world, there's only so much foreign dollars that there's available to flow back into our treasury. So you start to get major imbalances, and that's where you kind of get, in 2019, it was the repo rate that broke, and they had to go back to increasing their balance sheet. There are little like plumbing issues that break when you get really big imbalances of how much debt is stuffed into the market. And so they either have to do regulation changes to, for example, let banks hold more treasuries, or, which is kind of like shadow QE, or the central bank can come in and buy it, or they can regulate pensions to have to own more treasuries, but then you potentially impact their returns. So there's kind of trade-offs that they start running into when the amount of treasuries is very large compared to, say, the monetary base, or compared to bank balance sheets, or compared to foreign appetite for dollars and treasuries.